I'm Carl York with the Kansas Department of Revenue. Just need to let you know by attending this, we'll not flag you for an audit, so don't worry about that. What's said here stays here, sort of like Vegas, I guess. I'm going to do my best to give you good information. However, whatever I tell you today is not binding to the Department of Revenue, which ought to give you all the confidence in the world on everything I'm going to tell you. But what you may not realize is there is something available for you that is binding. It's called a private letter ruling. And what I have on the screen now is the web address where you would write in for a private letter ruling. So it's actually an email. So that's the general email address for the Department of Revenue. So that's why in the subject line, you would want to put in their request for private letter ruling and attention policy and research, or P&R, something along those lines. And a policy and research or a private letter ruling is designed for someone who is registered. So that means you have a sales tax number, you're actually in business, and something that's actually happening. So it has to be actual and factual. So a lot of times there'll be a lot of gray areas, and that's what this is for. Now, since this is binding, we will only answer the question asked. So we won't expound too much upon that. So sometimes I try to tell folks what might not be a bad idea is if you get an answer this way, this is going to trigger this this question, or if I answer this way, this is going to this way. See, I can hear and see. Okay, thank you. Someone let me know that they could see the PowerPoint in here. So that what I'm saying is so, well, if I get a yes, this is taxable, what's the next question? Or if I get a no, it's exempt, what's the next question? Also, we are tax nerds. We are not whatever industry you're in. So sometimes it helps us a lot if you can send us a picture of whatever it is you're asking a question about. And I'm talking about the kind you take, not the hand-drawn kind. I received one time that someone was a worse artist than me, and I can't draw stick figures. So yeah, everybody's got one of them cell phones nowadays. So that helps us, whatever you call this thing, and this is what we're doing, that helps. Statute quotes around 30 days for a answer to that, and it is binding. So it's based on your specific set of circumstances. So it's only binding to you. And it's only binding until something changes. So if there's some fact that changes with your situation, or perhaps the statute changes. We do publish private letter rulings on the Department of Revenue website. There's basically a database called the Policy Information Library. We call it the PIL. You have access to that, and we publish not all of them, but some private letter rulings. They scrub them so you don't know who wrote in for them. And although they're not binding, it's good information. And what I like to tell people is, if an auditor is going to go out and look at that before they come out and audit you, probably a good idea you look at that, because you have the same access they do. Now, if anybody's in an audit, I hope everything goes well. That usually if I'm live, I'll ask people if anybody is in an audit, because that does determine the mood of the class. And people always ask me, what triggers the audit? Well, they still do random audits. And one of the things they say that they do is they do it to educate. And oh, good. And someone says they're not an audit. Good. Well, see, that means the class will be in a much better mood. Like, I don't turn people in, because if I turned people in, no one would ever come to my classes. So I'm at the front end. I'm trying to make it so that hopefully if you're keeping your books and you're in an audit, everything goes well. Now, yeah, audits, they do educate. That's a hard way to learn though. So hopefully we can get you the right answers up front. Now, this class is dedicated to what we call contractors. So what's our definition of a contractor? We're talking about construction contractors. That's somebody I'm going to use some fancy words here. Somebody who installs or applies tangible personal property into real property. Tangible personal property, all that means is that's a physical item, like a 2x4, a piece of wire, a piece of conduit, concrete. That physical item, that's tangible personal property. Real property is real estate, so it's permanently affixed buildings and land. So when you install or apply tangible personal property into real property, you are acting as a contractor, and then you're in the whole different world called contractor sales tax. It's different than regular retail sales tax. Retailers, they have it easy. What they do is they buy what they're going to sell without sales tax. They sell it to whoever they're going to sell it to, and then they collect tax on the selling price. I really oversimplified that because we have a 2 or 3 hour class on that. So, but in a nutshell, that's what they do. They buy it without tax, collect tax on the total selling price. That's not what contractors do. It's different. Now, what you need to realize that the whole idea in Kansas is to have the sales tax paid one time by the final consumer, by the end user. When everything goes perfect, that's what happens. The end user pays the sales tax. Doesn't always work out that way. Also, since the statute for sales tax, it's under, you'll hear me say KSA, that just means Kansas Statutes Annotated. That's just the statute, the laws of Kansas. And 793603, that's the law, the imposition of sales tax. That's where they said, hey, this is taxable. If they started back in 1937. But in a nutshell, it says this. It says, hey, for this privilege of doing business in Kansas, you must register, collect, and remit sales tax. Okay, and it talks about sales tax for tangible personal property and what they call enumerated services. Enumerated, another fancy word, just means, well, it's written in statute. So, you know, and they're supposed to write this stuff in plain English, but I don't know whose plain English it is. It's not mine. But so you're going to install or apply that tangible personal property into real property. So, and it says the general, for the privilege of doing business in Kansas, you must register, collect, and remit sales tax. So here's what that means in a nutshell. That means generally, the default is when you sell something, it's taxable. And also the burden of proof that something is not taxable is on you. So I always tell everybody in your mind, and I am oversimplifying, I understand this, but in your mind, what you want to do and how you want to keep your records is to show, hey, I have collected sales tax or paid sales tax on everything I'm supposed to, or I have a good reason in my records why I didn't. Heaven forbid I'm ever audited. So my good reason's this and this and this. So now I have the easy part of telling you what the laws are. The hard part is making all of these laws fit into whatever software program you use. I'm not a programmer. So when I'm talking about this, I'm telling you right now, I know that I have the easy jobs, but we're here to help answer questions anyway, if you have something. Well, so retail sales, we basically say there's one part. They just collect tax on the selling price. For construction contractors, there's two parts to a contract. You see that there's materials and labor, but here's what you want to, for just sales tax, we're sort of like cavemen. We can't handle large concepts. So to us, if it's not the physical materials that you're installing and then are left behind, basically we're going to consider it labor. It'll be tax, the taxability will be the same as the labor. Whatever the labor is, that's a taxability of whatever. So you guys have fancy words like markup and overhead and delivery and per diem and made me smile on a Monday fee or delivery, all these different things, equipment rental fee. And so I'll get that question a lot. Well, is that taxable? And I'll say, well, is it the materials you installed? Well, no, well, it's the labor. So now we need to figure out, is the labor taxable? So that's what I'm just trying to show you here. Contract price, $9,000. Tax paid materials, which we'll go over that, $6,000. Labor, whatever's left, labor, $3,000. If you notice, you didn't even have to do algebra, which is good because I'm no good at math. That's why I went into taxes. If I was any worse at math, I'd do federal taxes. That's a bad joke, sorry. So I'm going to go over the materials. I'm going to go over the labor, and then we're going to mix them together and go over some possible exemptions. If you have questions, just let us know, and we will get your questions answered. If we don't have an answer for you, we'll get an answer for you and make sure we can email it and share it with you guys. So feel free to ask questions as we go. Okay, so materials. Now, hey, everything.
This meeting is being recorded.
Now it's being recorded again. Okay. So if you remember, I said that the end user is the one who really owes the sales tax. That when everything goes right, the end user, the final consumer. Well, here's the thing. For construction contracts, a construction contractor is considered to be the end user of the materials. A construction contractor owes the sales tax on the materials when they buy it. A construction contractor's customer never owes sales tax on materials. A construction contractor's customer should never see any sales tax on the materials. Here's how they come up with this. First of all, realize in Kansas, there is no sales tax on real property, on real estate. If you go buy a house, you will not pay sales tax on it. You will definitely pay property tax, but you will not pay sales tax. A contractor, they go and buy this tangible personal property, and then they install it into real property. Remember that. The second they install it into real property, they turn it into real property. It no longer exists in this world as tangible personal property. That is also the exact moment that they became the last person to buy that tangible personal property in the format of tangible personal property, thus meeting the definition of the end user. You know, an attorney must have come up with this, of course. So a contractor must pay sales tax on the material. And a contractor's customer, no matter what kind of job it is, should never see sales tax on materials. We'll get to how you get that back. Now, as you see, there's a designation there, retailer contractor. You'll also see it called contractor retailer. What I want you to do is hang your hat on that word retailer. What this is designed for is a business that is primarily, mostly a retail business. Retail business, they have stock of normal inventory. They have a showroom floor where you can go shopping and buy the stuff. And the majority of the people they sell the stuff to are taking it with them and installing it themselves. They're not hired out to install it for the customers. However, from time to time, they will act as a contractor. So I don't know if you've ever been to Home Depot or Lowe's or Menards or one of those big places. And most of the time people are going in there, buying the stuff and taking it with them. They're DIY places. However, if you walk through there, you'll see that there's different things that they will install you. So if you go get a water heater, they say, hey, let us install that for you. Okay, well, now they're acting as a contractor because they are installing or applying. So contractor retailers are allowed to buy all of their inventory without sales tax because they're a retail business. Now, when they install or apply into real property, they're acting as a contractor. Do they get out of the loss? Do they get away? No. They have to pay sales tax on the materials. They just have to take the scenic route to do it. It's actually more difficult. What they do is they report the sales tax at what they paid for it on the materials on their sales tax return on the next time they file their sales tax return. It's a line called merchandise consumed. So they're still paying sales tax. They don't get out of it. They just do it on their sales tax return. So you must be a contractor retailer or a retailer contractor in order to do that. It's much easier for bookkeeping sakes to just pay sales tax right up front and save your receipts, and make sure you do save your receipts. You can save them electronically, PDF. I always say save it in more than one way, back it up. So contractors, contractor retailers, they have to pay sales tax on materials. They don't get out of it, either one. In fact, we have a regulation, I included that here. It's 92-19-66, and it basically deals with contractors, and it's talking about their materials. And we talk about contractors, subcontractors, and repairmen, and we're talking basically around about the same thing. The repairman's a little different, but I'll talk about that a little later. But it says right there that the subcontractor, repairman is deemed to be the final consumer of materials used by the contractor, subcontractor, repairman for construction projects. And it talks about that they are not able to use a resale exemption certificate and a retailer is not able to accept one. It also talks about that you owe the tax on the materials, even if you're doing a construction job outside of the state. And what I'm talking about there is if you purchase and buy your materials in Kansas, and this is for a job outside of the state, since you are picking them up in Kansas, in the Kansas jurisdiction, the laws of the state apply, so you would owe sales tax on those materials. It does not matter that you're going to go install them in another state. So just letting you know, that's in an audit, that's one area that some contractors get caught on because they just didn't understand that. They're like, well, I'm doing the job in the other state. Yeah, but you picked them up in Kansas. We're destination sourcing. So, but what that means is the sales tax rate that is collected by the business is the combined state and local sales tax that's in effect where the end user takes delivery. Remember, the contractor is the end user of the materials. Now, if I'm a contractor and I order, let's say I'm an electrician and I order a bunch of electrical parts from a parts house, and I normally go there when I've got a job here in Kansas, I go and pick them up and pay the tax right there. But I have a job in Missouri, so I order them and I say, hey, can you guys just deliver that to Missouri? That'd save me the hassle of having to haul them over. And they say, sure, we can do that. Well, now I'm taking delivery of these materials in Missouri, not in Kansas. That retailer will not collect sales tax on those simply because he won't collect Kansas sales tax, possibly Missouri, but he won't collect Kansas sales tax. The reason why is if it goes outside of our state, it's out of our jurisdiction. Kansas laws are only good in Kansas. We can't enforce our laws in another state, and other states can't enforce their laws in ours. So if you take delivery of it outside of our state, it's out of our jurisdiction. And so it's now subject to Missouri's laws, whatever their laws are. So just FYI. So in the Kansas City area, what a lot of contractors will do, depending on where the job is they'll order them and have their parts delivered out to the job site. Now, sales tax, the sales tax rate is destination sourcing, and it's for the end user. The contractor's the end user materials. Remember that. This is very important. What I'm trying to tell you is the sales tax rate on the materials may not necessarily be the same rate as the labor. Could be, but not necessarily. Remember, it would be where the contractor picks up the materials, where they take delivery of them. So if you take delivery of the materials at the job site, well, yeah, now it's the same as the labor. But if you take delivery of them at your shop, well, it's there. If you go pick them up at the store, it's there. So this is another area where you can get caught in an audit that you want to double check that. Also, this is another area that you can actually save yourself money. There's nothing that says you cannot go buy these in a jurisdiction that has a lower sales tax and pick them up there. So long as you pick them up there and pay for them there, actually take delivery of them there. That's the jurisdiction that they would collect sales tax in. So for example, in Wichita, 7.5%. Outside of Wichita, it's higher. So if you go into Wichita, pick up your materials, even if you have a job outside of the Wichita, at least your sales tax is on at 7.5 because you took delivery of it in Wichita. But if you go into Wichita and say, hey, deliver them to me in the site at the work site, and it's outside of Wichita and it's higher, it'll be that rate. So you can use it to your advantage, and there's nothing wrong with that. I have a lot of contractors that have come to my class before that tell me that they do that. And they think they're going to get in trouble, but no, the law says it's where you take delivery. So you take delivery of them there, no problem. And you'll have a receipt, actually. Basically, it'll tell you. It'll have the jurisdiction a lot of times on there. So you can use that to your advantage. Also, if you happen to buy your materials outside of the state of Kansas, you possibly could owe tax. So we have compensating use tax. Now, most people don't know what this is. It's nothing new. What this is, what the law talks about as well. If you buy something you are the end user of, you're not reselling it, you're the end user, and you use it, store it, or consume it in Kansas, you bought it outside of Kansas, didn't pay any sales tax, or the amount you paid in the other state is less than our combined state and local sales tax, then you would owe the difference, and it would be called Consumers Compensating Use Tax. Most people think this law has been around since the internet boom, but it's actually been around since 1937, since the start of sales tax and compensating use tax. And any state that has a sales tax has a form of this, and they don't always call it this, but they do. And what it's designed for is when you do buy something outside of the state, if they deliver it to you, remember, they're not going to collect their tax sometimes if they ship it to you. So if you bought something and didn't pay any tax on it, well, now you owe tax in the state. They're basically saying if it's taxable, you should be paying tax. So that's what they're saying. So now this will be the first year since 2003 that the Kansas personal income tax return will not have a line on it for use tax. We had a line on there since 2003 where you could, as an individual, report it there. So now we do not have that. So an individual will have to file a compensating use tax return to comply with the laws there. Now, this would be the stuff that you're the end user of. So this would be your materials, your tools, your equipment, that type of thing. So let's say you're a drywall and you go get some drywall in Oklahoma. And let's say their rate is 7%, you come back to Kansas and ours is 8%, you would owe the difference of 1% consumers compensating use tax. Now, if theirs was 8% and ours was 7%, do you get a refund? No, you just don't owe any, you keep the receipt. Compensating use tax is the exact same rate as the sales tax, dollar for dollar. There is no threshold in which it kicks in. So, for example, I mentioned Wichita at 7.5%. The sales tax rate is 7.5% there. The consumer's compensating use tax rate is 7.5%. So that makes it easier to figure. So this is one area where most businesses, not just contractors, but most businesses get caught and first learn about compensating use tax. That's a tough time to learn when you're audited, because it's like, I had no idea that it was even a law. And in fact, we've been accused of making that tax. You just made that tax up. It's like, we haven't. It's been around since 1937. So just FYI, now that you know, now you can just plan for that. Let's see here. So there is something called Nexus. You'll hear a lot of states and a lot of tax practitioners and things like that talk about Nexus. And basically that is a word. It's means a significant or sufficient presence in a state. So what this means is if you have a physical presence, a physical connection in that state, that's the threshold at which the state can require you to collect sales tax on any sale into their state. Now, before it used to be, well, if you make deliveries with your own vehicle, that is a nexus, that is a connection, that is a presence. If you have an employee in that state, that's a presence. And then, of course, if you own or rent real estate in that state, that's a nexus. So that all still is true, but there is now what they call nexus, just because you have sales into that state, enough sales. So this is because of the South Dakota Wayfair Supreme Court case. Basically, South Dakota said, well, if you sell into our state and your sales exceed $100,000 in a calendar year, or if you sell 200 times, we're going to consider that an economic nexus. That's the key word, is economic. And we'll require you to start collecting sales tax from that point forward. So you could actually create an economic nexus in any state just by breaching their threshold. Now, every state that has sales tax, I believe all of them now have a law, and they're going to follow what the Supreme Court did to South Dakota. So that South Dakota won that, by the way. So exceeds $100,000 in sales. That's what majority of the states do, although some of them, instead of say exceeds $100,000, some of them say $100,000. Some of the states say, well, both taxable and non-taxable sales are qualified for that threshold. Some of them say only taxable sales. Some of them don't have the how many number of times. So what I'm telling you is you're going to want to contact that state if you got sales into that state. Now, the good news is no matter what state it's in, if you do meet their threshold where they can require you to start collecting their tax, it would be forward. They would never, it can't be retroactive. And that's one thing the Supreme Court was pretty adamant about. So it would be from that point forward. They wouldn't go backwards on that. So that's kind of good news. So you don't, I mean, that would not really be fair if they said, well, now you breached it, so now you have to go pay tax all the way. No, that wouldn't be fair. So one way or another, I've kind of browbeat you guys, but yeah, you pay sales tax. Most of the time, you're going to pay sales tax on the materials or compensating use tax. So just remember, 99.9% of the time, I owe tax if I'm a contractor on the materials. I should be paying that. Now the labor, remember 2 parts. So material, now labor, and I'm just going to talk about the labor. General rule is that the labor to install or apply the materials is taxable. That's the general rule. And I'll talk about, that's the rule of law, and I'll talk about the exceptions to the law and of course the exceptions to the exceptions. But general rule is I pay tax on my materials and then I collect tax on the labor. Now, remember, installing or applying, that's actually in the statute where it talks about that. Sometimes someone who works on real property may not be installing or applying anything. So that would be someone like mowing lawns or trimming trees or raking leaves. What are they installing? They're removing. Cleaning. If you're just cleaning, plumbers, when they get a clog out, they're cleaning the drain. Now, most of the time cleaning is not taxable. However, there are exceptions to that law. It's not construction contractor work, but washing and waxing of automobiles is taxable. Laundry service is taxable. Okay, so that, remember, that's the exception. Here's the exception to the exception. Coin-operated laundry machines are not taxable. So that was an exception and then an exception to the exception. No wonder it's confusing, right? Cleaning, testing, if you see backflow testing and testing, just testing is not taxable. Now, when I'm telling you these things are not taxable, what I'm saying is this is all that's happening. If there's nothing else going on, it's a standalone job. All I do is clean, or all I do is rake the leaves. I'm not doing anything else. That's it. Well, that's not a taxable service. However, very important, there is something in our law called gross receipts. And what is gross receipts? That is, you'll hear a bookkeeper and accountant call it, well, that's the tax base. What's the tax base? Fancy word. It means out of everything I charge my customer, what portion of that am I required to collect sales tax on? That's the tax base. Well, it says out of everything that you charge your customer, you can subtract out of it any tax paid materials or tax paid subcontractors, whatever's left. That's taxable. It doesn't matter what you call it. You might call it per diem or I don't know, testing. If it's testing and it's sold with something taxable, it now becomes part of the thing you sold. It's not just a standalone thing. So let me give you an example. I always give my example from Garden City about 7 years ago. There's an electrician. He got called from a gal that owned a bakery, and it was around Christmas time, and she said, hey, I got an outlet that went out. I need you to come fix it ASAP. And he said, well, I absolutely can do that. I had charged an $80, he called it a trip charge. Just so basically $80 just to show up. And she said, fine, I need it because I'm cooking, baking, whatever. So he shows up there and he goes down in the basement and he tests the breakers and then tests the wiring, and then he tests the receptacle itself. Everything tested fine. What happened was she plugged in like 15 things into one outlet. She overloaded an outlet. It was 20 amps. She probably had 30 amps worth of things plugged into it. He said, don't plug that many things into it. So all he did was test. He didn't install anything. So $80, no sales tax, and she gave him cookies since it was Christmas time. It was a wonderful gig. Okay, I'm going to change this though. Let's say the same thing happens. He gets called, he goes there, checks that breaker panel, everything's good, checks the wiring, everything good, checks that outlet, that receptacle, it's bad. Okay, so he needs to put in a new receptacle. Well, he buys these by the gross, so he, pays $2 for them or something and charges $5 or $10. So he changes out that receptacle, everything's good. Well, now he installed or applied. So now the whole job is taxable because of that law, gross receipts. So not just the $5 receptacle, but the $80 trip charge. It's all part of what he charges, the gross amount. And the gross amount is defined as the total selling price without any deductions for delivery and overhead or anything like that. So that's a big one. That's one that would catch a lot of contractors. So we always say, be careful with that. If you're just doing one of these non-taxable things, no problem. But make sure you're not doing anything else, because if you're doing anything else, that whole thing can be taxable. I call it the whole schmear. Okay. Hopefully everybody's got that, because I'm going to just flip you on your ear here. So what I need from everybody is just imagine your brain as a file drawer. And I want to have one empty drawer right now. And on the front of that drawer, I want you to label it excavation. Only excavation. You're not going to let anything else fall into that drawer, just excavation. Okay, excavation is not a taxable service. What is excavation? What is that? That's digging a hole in the ground, filling it in with dirt. That's trenching, that's plowing. Excavation. So that is not a taxable service. Okay, we got that. However, excavation is different than all those other services there. Okay, it's different. We're not going to let anything else fall into this. This is just excavation. We are able to separately state excavation and it will remain non-taxable so long as we separately state it on our invoice to the customer. If we do not separately state it, if it's included with taxable things, it just becomes taxable too, just like gross receipts. So let me give you an example. Let's say we have a job at an existing commercial building and they need us to come out and dig a trench. Okay, that's excavation. Doesn't matter, it's a commercial job. Excavation is not a taxable service anywhere. So we go out and we dig the trench. Well, that part, no tax. They also want us to get some gravel and install that in there. So we go buy the gravel, pay tax on our materials. We install it, collect tax on the labor for that, but we separately state the excavation so that that portion remains untaxable. So fill it in with the remainder of the dirt. Well, that's part of the excavation portion, so that part's not taxable. So I'm able to break out either however I bid, or however I charge, if I charge by the hour or by the job or whatever, I'd work out the percentage of labor that is involved with the excavation compared to the installation of the rock, and can save a lot of money. And what that normally does is it increases the contractor's profit just because they're able to do that. So excavation only though, okay? And the reason why, there was a Court of Appeals case years ago in the 80s that, so laws not only made by the legislature, but it can be made by the courts as well, which actually that's what the Nexus laws with the economic nexus happen. Now, hopefully everybody's got that, because I'm going to flip you on your ears again, because now starting in July, July 2023, July 1st, it was part of the legislation this past year, and they said starting July 1st, 2023, delivery charges that are separately stated on the invoice to the customer will be exempt from sales tax. Now, remember, if you do not separately state them, they're just going to be part of the gross receipts and follow the taxability of the whole thing. Well, that's a big deal, because a lot of contractors have delivery charges. It's part of the labor, and that turns out to be quite a bit. So again, that can save money, hopefully increase your profits. So the delivery charge, now it doesn't start until July 1st. So until then, we're still gross receipts with delivery. Delivery is still going to be taxable if the labor's taxable, is what we're saying. But that's a big deal. So you might want to mark that one in your head there. Now, the two big exceptions are for the labor is, well, remember, we're still paying tax on our materials, but if we're doing a job and it's residential, it's at a residence, there's no sales tax on the labor. Well, the statute literally defines the residence as basically a place where somebody would customarily live. So do people customarily live in houses? Sure they do. Pay tax on materials, no tax on the labor, it's residential. Do people customarily live in an apartment building? Sure they do. Now, just the apartment units, the common areas would not qualify for that. So if you're doing something that affects the whole complex, you can still exempt the residential portion. You just have to come up with the total square footage compared to the remainder. So the whole with the residential broke out. But if you're working completely on, let's say you're an HVAC person and you're working on this HVAC system that cools this apartment, well, that's residential, no problem. Same way with a traditional nursing home. A nursing home, the only residential portion there are their private sleeping rooms. So the rest is commercial. The rest, the common areas and everything, even outside, is going to be commercial. A mobile home, so long as it's hardwired and hard plumbed. So we're not talking about like a travel trailer or a fifth wheel or anything like that. Those do not qualify, and because they're not considered real property at all. They're just tangible personal property, so they wouldn't fall under these laws. They're just gross receipts like a regular retail sale. And I've had people say, well, yeah, but we've hardwired it. And I'm like, yeah, but basically it's in the law that says that. And also it talks about that when they go register that, it's registered as tangible personal property, like a car. So let's see, a hotel is not residential. It's considered what they call transient. Most of the time people temporarily stay there, although we probably all know somebody who has lived in one, and they do have long-term, but it's going to be commercial. So if it's residential, paying tax on materials, but no tax on the labor if it's residential. Okay, the next exception, and I'm not, you know what, I should have told you guys this, but you guys probably got an attachment with an email, and it has our publication, business taxes for contractors, subcontractors, and repairmen. And if you look in the lower left-hand corner, the publication is a KS-1525, KS-1525. And we are updating these, so you might stay tuned to see the when a new one gets out there. But everything I'm talking about is in this book, and it's not a bad reference. And right now I'm going to be talking about something called original construction. So I'm quite certain you guys, or at least most of you, would know what one of the definitions are, but there's actually 5. And they would start on page 6 in that 1525 contractor book. So the first definition is the one that contractors know. And it is the first or initial construction of a building or facility. Now, I want you to be aware that I put in red there, building and facility, and I underlined it. The reason I did that is because it's only for a building or facility, nothing else. So what's a building? Well, it's basically a structure that houses people and property. A facility is a mill, plant, refinery, oil, gas, and water wells, feedlots, and then only the distribution lines owned by rural electric co-ops and city electrical. So that's what a facility is. So building or facility. So when we're saying original construction, it's only of a building or facility. So the first time it's built, first or initial construction of a building or facility, pay tax on the materials, no tax on the labor. No exemption certificate for that, by the way. So you'd need to probably have a copy of the building plans. For that residential is easy. There's no exemption for that, but all you need is an address for that one, a residential address. So that's one definition. The second definition, you can kind of tell that someone had a question, and so they just wrote it into the law. And basically it says, well, if this is an addition to an entire room or floor to an existing commercial building, that this would be original construction of a building. So we're saying commercial because if it was residential, it would be exempt by being residential. So residential doesn't matter if it's remodeled, doesn't matter if it's original. If it's residential, it's going to be, the labor will not be taxable because it's happening at a residence and the immediately surrounding area. That's why a residential fence and maybe a shed at a residence would be exempt for labor as well. Material is still taxable. So we're adding an entire room or floor to an existing commercial building. The key to that one is you were adding square footage. So that, and hang on to that, because all the time I'll have someone ask, well, we just put a brand new wall in that room. So if they hired a contractor and they built a wall in my office here, is that original construction? Well, no, they didn't add any square footage. They just took this space and divided it into two. It's absolutely new construction, but it's not original construction. So instead, we hire a contractor to knock out the exterior wall and we're going to add on. Well, now we're adding square footage. Now you have original construction of a building. And in fact, anything that's required for that original construction project there, even if it's happening inside the existing building, if it's absolutely required for that original construction job, it'll be part of the original construction. So an example I like to give is if, let's say we have the electrical room right in the existing building, and we have to add another sub panel or something like this because we have to run electricity to that new addition. Our panel's full, so we hired an electrician to come in and they put in, they're doing all the work with this brand new panel and everything in the existing building because that's where the electrical room is. But since that is basically dedicated and required for that original construction job, it's going to be part and parcel to that. It'll be part of that original construction, and they call it in conjunction with that. So if something is in conjunction with the original construction of a building or facility, it gets that treatment as well. So if we were have an existing commercial building and we're building a brand new McDonald's. Well, if we hired a company to come and put in the parking lot, since that parking lot is in conjunction with this original construction of a building, brand new building, it will be part of that original construction. However, if we have just let's say we have an existing McDonald's and we hire a business to come out and put in a brand new parking lot next to the old one, so we have more parking, well, that's not original construction anymore. It's new construction, but not original construction, because that's not a building or a facility, and it's not in conjunction with that. So that's where that building and facility is very important, by the way. Let me see, that's what, 2 definitions? Third definition is the weird one, and that's a technical term, I think. We're saying we're going to count it as original construction, even though what's taking place is not happening at the time of the original construction. So in that book, you'll see that there's 4 criteria. So it's with the completion is in the original blueprints or work plans. So it was always planned for. This isn't an afterthought. So what you're doing was always part of the plans. The second criteria is, well, this is within a reasonable requisite of time of the original construction of that building or facility. How long is a reasonable requisite of time? It depends on the job. There's no set amount. So a little subjective, I guess, the reasonable, but you can figure the statute of limitations 3 years. So likely it's not going to be able to go that long, but if it's just a painting inside a small area, reasonable would not be a year. Reasonable might be a couple months. So it depends on the size of the job, what you're doing, that type of thing, the reason for the delay. The third criteria is that the owner or occupant of that space is the first or initial owner or occupant of that space. Okay. And then the last criteria is the work would have been performed at the time of the original construction, except for circumstances beyond the owner's control. So what we're really talking about here is like a tenant finish. So let's say we have we're building a small strip mall. And small, let's say we got 5 or 6 separate places for 6 separate businesses, and we're going to lease it out. So let's say we have all but one of these spaces leased out. So we have the other one advertised. We're waiting for it to get leased out, but all of them are leased out. So we have advertised that one that's just basically a generic white box finish, waiting for us to know what to make it into. Well, finally we get that Patrick Mahomes Whataburger or whatever it is, and he's going to make a Patrick Mahomes Whataburger there. Well, it took a year for him to get there, but under that scenario, I think that's a reason. So let's go down the list and see if it qualifies. So remember, there's 4 criteria. So the work was called for in the original blueprints. Yeah, there was always called for a business to be in there, so you can check that one off. This was within a reasonable requisite of time. That scenario, I would say, yeah, a year. I mean, he's done nothing more he could do. He's advertised it. So yeah. The owner occupant is the first or initial owner or occupant of that space. Yeah, no one's ever been in it. So they're the first occupants of that space. And this would have been performed at the time of the original construction, except for circumstances beyond the owner's control. He was trying to lease that out. So yeah, that's definitely beyond his control. So check, check, check. 4 checks. And you know now that this is original construction of a building. And you know you're going to pay tax on your materials, but now you know, since it qualifies, hey, there's no tax on my labor. Do you know that most contractors do not know this law right here? So the reason I tell you that is whatever industry you're in, your competitor likely does not know that law. So what I'm telling you is they're going to see this job and they're going to say, oh, commercial, I better pay tax on that. I don't want to get in trouble. Most of the time I'd say, well, you're probably right. But this is an exception to the law. So since you know this, and you know they likely don't, here's what I'm telling you. You can actually, on this particular job, make more money than you normally do and charge less money than you normally do. So let's say we have 8% sales tax. Well, I got 8% to work with that they don't really know about. So I'm going to charge 4% less than I normally would. And because I don't have to pay sales tax on my labor, I'm actually making 4% more than I normally do. Charging 4% less and making 4% more. Wow, that's a good deal. So it's a pain in the neck law sometimes, but heck, what I say is turn it on its ear and use it to your advantage. There's nothing wrong with that. And you don't have to tell your competitor about the law. It's up to you. You can, I guess. So that's 3 definitions. The 4th one, another one that not all contractors know about. Now, more know about this one, though. So if we hire you and you're doing this work because it's damaged and the damage was caused by a fire, flood, tornado, lightning, explosion, ice loading, attended winds, windstorms, terrorism, or earthquake. If it's caused by one of those things. Now, the question I get a lot of times is, what about hail? And I got to say, hail, no. Hail, no. Hail's not in there. So if it's hail damage, it's not going to qualify. But one of these others, so what is attended winds and windstorms? That's wind speeds of 80 miles an hour or more, which is actually 5 miles an hour greater than a Category 1 hurricane, or Thursday in haze. It's always windy out there. The flood, what they're talking about flood there are natural disasters. We're talking about overflowing of rivers, streams, and lakes, possibly torrential rains. We're not talking about a broken pipe in a basement or anything like that. Ice loading is an industry term for the overhead electrical wire. So it's the amount of ice that accumulates on that electrical wire, that ice loading. So again, it's not frozen pipes or anything like that. Let's see. I think that's so fire. Of course, we know what fire is. So now remember, I told you on this original construction and residential, there's no exemption certificate. But the burden of proof that something is not taxable is always on you. So what can you get? Let's say we have a fire at a Sonic drive-in. And so you're going to go in and fix this Sonic, and it just burned down part of their kitchen. So you're not rebuilding the whole thing. You're just going in there fixing the kitchen. Well, it's damage due to fire. So long as it's not arson, so vandalism does not qualify for the original construction. So, but let's just say it was an accident. So they're going to hire you to come fix this. Well, damage due to fire. Yeah, that's original construction. So what can you get to prove, heaven forbid you're ever audited, that, hey, this was original construction because it was damage due to fire? Well, chances are you'll get an insurance document. So get a copy of an insurance document. That'll tell you fire. Possibly a copy of a fire report, a police report. Now, you cannot take pictures. I mean, you can take pictures, but we won't accept like your pictures off your phone, simply because my nephew can make me look on fire. But if you put in your records possibly an article in the newspaper that had that, maybe it has a picture, but an article that talks about that, that's proof. If all else fails and you can't find anything else, get a signed affidavit from the owner or manager of that property and have it notarized that says this is what happened, this is the date, and that way that will qualify for the original construction. And when you let them know that it's going to cost them less if they comply with this rather than if they don't, because you'll have to tax the labor if they won't give you anything and you have no proof. So sometimes that's a motivation for them to comply with your request there. So that's so yeah, you get one of those documents as proof. Let me see the last definition. I'm not sure if we have anybody in here that does bridge or highway work. So we're talking public bridge or highway, not private driveways or anything like that. So if you're a company that does bridge or highway work, then your labor is going to be exempt as original construction. So I'm going to call all of those definitions, I'm just going to call all of those original construction now, but when I say that, I'm meaning all 5 definitions. And then residential. So pay tax on materials, no tax on the labor if it's residential, and no tax on the labor if it's original construction of a building or facility. So when is the labor taxable? Well, here's what you do. The labor is taxable. All you have to do is reverse engineer residential and original construction, because that's exactly what commercial remodel is. So a commercial remodel, commercial means a place where somebody does not customarily live. Remodel means, well, it's not original construction of a building or facility. Well, that's why I took you through those first. So commercial remodel. Now, hang your hat on the commercial, because remember, residential doesn't matter that it's remodeled. The first word was residential. You're okay. If it's residential, no tax on the labor. Okay, and remember, no exemption certificate for this, but this is exempt. Residential is easy and address. One of these things, you'll have to get a copy of the building plans, possibly a signed affidavit, possibly an article in a paper, an insurance document, fire document, police report, that type of thing. Okay, well, I browbeat you about them materials, about paying sales tax on materials. Remember, I said that, hey, you owe the tax on materials. Your customer never owes tax on materials. I said your customer should never see sales tax on materials. Indeed, I said that. But I never said they would not feel the sales tax on materials. They absolutely are going to feel the sales tax you paid on the materials. They have to, because you can't afford to just pay sales tax on materials that you're not keeping. But here's the thing, you are never going to call it sales tax ever again. It's going to be part of the price you charge your customers. So what we're saying is you're going to mark up your materials. What is markup? That means, well, I'm going to charge you more than I paid for it. That's how I recover my costs. So, but I'm just calling it materials. Now, here's the thing. Remember I said 2 parts to a contract. If it's not materials, it's labor. If it's not, let me even go a little more clear, a little clearer. If it's not the physical materials that I install and are left behind, then it's part of the labor. It'll follow the taxability of the labor. That's what I'm saying. So all the time we get questions that say, well, when I have to get my tax back, but I mark it up, is that taxable? Well, let's see. Is that markup something you install? Is it left behind? It's not a physical item. It's a calculation. So remember, if it's not the physical materials, it's labor. So it's going to follow the taxability to labor. So someone asked me, well, this markup, is it taxable? I'm going to say, well, it depends. Is the labor taxable? Well, it's residential. Sure thing. Yeah, it's just part of the labor. Yeah. So that's what I'm saying right here with this couple paragraphs. And by the way, these are not in the publication. I need to put them in there. But basically, I'm saying the markup on materials on residential and original construction, which residential and original construction, remember, no tax on the labor, right? So I'm saying the markup of materials is not taxable when the labor is not taxable, because the Kansas Department of Revenue considers the markup of materials to be labor. Thus, if the labor is not taxable, the markup on the materials is not taxable. And I say the exact opposite thing when the labor is taxable, which would be a commercial remodel job. So I browbeat you about paying tax on that. You get the money back. It's just never called sales tax. It's markup, and it's going to be part of the labor. And here's another reason that leads me to my next slide that says, hey, there's 2 ways to invoice your customer. For construction contractors, we recommend the second way. Now, the first way is, well, we itemize it and show it. You go to the grocery store, you go to a convenience store. We're used to that. We see that. You go to a restaurant, they show you the sales tax, no problem. But the law says, and I actually wrote you the law in there, 793648. It says, well, there's another way you can do it. You don't have to show any sales tax so long as you have language on your receipt that says all applicable sales tax included. What that language means is if what I sold you, what I did for you was taxable, I collected the appropriate amount. If what I sold you, what I did for you wasn't taxable, I didn't. So they do that. Don't show any sales tax. Now you can still, I made the simplest invoice there with just the price and just that language. I could still itemize out all of my materials and detail my labor and then have the cost at the bottom, all applicable sales tax included, not show sales tax. And that protects you because contractors get short paid more than anybody. Because someone will say, hey, that's not taxable. And then they pay you everything except the sales tax. And I always ask everybody, well, if somebody pays you everything except the sales tax, do you owe the sales tax? The answer is yes. Yes, you do. In fact, if it was admissible in court that I could say, hey, judge, they didn't pay me tax. That's why I didn't pay tax. If that was admissible, no one would ever pay sales tax. Also, this is what they call a trust tax. So the second you do something taxable, you are holding, the state is trusting you with the tax money until it's your time to send it in. So it's one of those things. So you have to protect yourself sometimes. Now, a lot of times it's other contractors that will short pay you because they won't understand the law. So I don't know if you've ever worked for a general contractor or are a general contractor. I don't know if you've ever heard a general contractor say, don't you tax me because I'm taxing my customer. It's double taxation. Well, he doesn't know what the tax base is. Remember I told you, I said, out of everything I charge my customer, out of the tax base, I subtract out of that any tax paid materials I purchased and any tax paid subcontractors I hired. Whatever's left, that's the amount I collect sales tax on. So if I'm a general contractor and I hire you, yes, you're called a subcontractor, but for us, really, you're nothing more than a contractor. It's the same thing. The general contractor is nothing more than your customer. So on a taxable job, you're going to pay tax on your materials, and then you're going to collect tax from the subcontractor for the labor. No problem. So I hire you to do this, and you pay tax on materials, and you collect tax on the labor from me. And I ask you, by the way, I'd like you to invoice me with the language on there that says all applicable sales tax included and not show any sales tax. Why would I want to do that? Well, now I have an invoice that says I paid all applicable sales tax. If you did something wrong, it's on you now. It's not on me. So offers a level of protection for me as well. So now I'm selling this to my customer. I didn't buy any materials, but I did hire you, and I paid tax on it. So out of everything I charge my customer, I subtract out of it any tax paid materials, didn't buy any, but any tax paid subcontractors. I subtract out what you charged me. Now I'm going to mark this up a little bit so I make some money. Well, guess what? That's the portion that will have sales tax on it, right? And I'm going to invoice my customer all applicable sales tax included so they don't see my markup. So that's how that works. So if you ever hear somebody say, well, it's double taxation, well, now you know they don't quite get how you're supposed to do it. So because you're not allowed to give a resale exemption certificate, the labor for contractors is never exempt. You cannot, well, I don't mean that. It's never, you cannot resell labor, contractor labor. So yeah, it can be exempt. I just told you what can be exempt, residential or original construction. So are there times when you can get some exemptions for construction work? There are. Tax-exempt entities. We'll talk about those. We'll talk about some project exemption certificates. We'll talk about manufacturing and warehousing. That's the integrated production machinery equipment and the warehousing exemption certificate. And then public water suppliers. Public water suppliers are kind of their own thing. Basically, this would be somebody who does work for a public water supplier that is paying the clean drinking water fee. If they pay this clean drinking water fee, they have an exemption on just about everything. It's sort of the trade-off. So they will have their own form. It's an ST-28EE. You'll see that, but they also could get a project exemption certificate. So you may see that. So I'm not sure if anybody does work for public water suppliers, but it's pretty specialized, to be honest. But if you do, and you get a certificate, you get a project exemption certificate from them, or you get an ST-28EE, which is only for them. You can't even get that on the on the web. So yeah, that would exempt your materials and labor. Now, tax-exempt entity. What is a tax-exempt entity? Okay, tax-exempt entity. Here's the thing. A tax-exempt entity, there is a criteria for a tax-exempt entity. A tax-exempt entity must first be a nonprofit organization. Okay, well, that nonprofit status is a federal income tax status. That's actually not a Kansas status, although we recognize it, but so it's an income tax status. So the reason I tell you that is just because a place, an organization is nonprofit, that does not mean they are automatically exempt from sales tax. They have to meet the criteria. So first, nonprofit, yep. Well, then there must be something written in the statute, which is the exemptions to sales tax, that's 793606. Must be written that they are specifically listed in 793606, or they qualify under one of the categories listed in 793606. So that takes legislation to do that. So they're either specifically listed or qualify under one of the organization, one of the categories listed there. Then that's two. The third one is they have to apply to the Department of Revenue to become an exempt entity and receive an exempt entity certificate. So if they didn't meet any of all of those criteria, then they would pay tax like you and me. Now, there is an exemption certificate book. It's the KS-1520. I think you have a link to that on or about page let me see, 14, maybe somewhere in there. You'll see a list of tax exempt entities. These are all this is all from 793606, but it's all the letters and subletters and things like that. We listed it out for you. But you'll see on there specific entities like Jazz in the Woods. I'm not sure if you guys know what that is. It's a organization that puts on a jazz festival at Corporate Woods in Overland Park to raise money for a charity. Johnson County Young Matrons. I don't really know what they do. In fact, I had someone in my class in Johnson County who was a member of that, and they didn't really know what they do other than they're philanthropists that help certain charities. Okay. But then you'll see categories like religious organizations that we're talking about, like churches, cities, counties, political subdivisions, schools, universities, tax-exempt entities. Most of these tax-exempt entities, first of all, if they are issued an exempt entity certificate, right next to the list of that, there is a sample exempt entity certificate. And most of those organizations that I just told you about, their exemption goes like this. It says in statute that their exemption is for direct purchases only. Here's what direct purchase means. That means the money must come directly from them in order to be exempt. It cannot be a reimbursement. In fact, it even says that on their certificate. It says right on there, and they put it under retailer information. So whoever's selling them, it's like, heads up, this is what it says. Payment must be made by the entity on their checking account or on a credit debit card issued to the entity. Acceptance of cash, personal check, or personal credit debit card is not allowed for a tax-exempt purchase. So if it's not a direct purchase, it's not exempt. Okay, so all the time you have like a church, a city, a county, they'll give you their exempt entity certificate. And so you're doing construction work. So you're going to go put a roof on this church and they give you this. Well, remember that exemption is for direct purchases only, because that's what their exemption says in statute 793606. So, okay, if this is what they give you, no problem. Okay, I got this. Remember, you owe tax on materials. So normally, so you go to the store and you're looking at the exemption, like, well, I'm actually buying the materials. So the money's coming from me, not the church. That's not a direct purchase. Yep, you need to pay tax on those materials. Okay, so now you do the roofing job and now you charge them. And so they're paying you directly for the labor. And by the way, you're not going to show them the tax on the materials. Remember, you're going to mark it up and you're going to put all applicable sales tax included. And then you're going to charge them for the labor, and there's no tax on the labor because they are paying you directly. If this is the certificate they show you, right there, I got it on there. If this is what they give you. Now, if you read on their exemption certificate, it will tell you that for real property project, that's construction, they have a process that they possibly could be exempt. It says this entity qualifies for exemption on indirect purchases by a contractor through the issuance of a project exemption certificate, call them PECs. PECs should be obtained from the department prior to starting the project. Apply online. Emphasis on prior because they can never backdate these. You can't go backwards. So this entity, they would go online and apply for a project exemption certificate. It's not difficult. Doesn't take that long. We've got a gal here that does a real good job of taking care of those. So as soon as she gets it, she'll look it over. If everything's good, she okays it and they can just print it off. So this project exemption certificate here's the way to look at it. Remember, their exemption is for direct purchases only, but they have this special privilege. It's only for real property projects that for a snapshot in time, there's a start date and an end date. For this snapshot in time, for this specific project, for this specific thing, their exemption will get carried over to you, the contractor, for indirect purchases. So it's only only the start date and end date. So it's only good between those dates. So that will exempt your materials and your labor. And also, if you hire a subcontractor, that will exempt their materials and their labor. Okay, because it's only a snapshot in time. Now, don't buy your materials before that start date is what I'm telling you. You can buy them the day before, taxable. Yeah, but we got a project exemption certificate. Yeah, but you purchased your materials the day before. It was not covered under that. That's happened. So I'm just trying to give you a beware of this type thing. Now, that end date coming, you can see it coming. So if you get, there's all, remember, this is an estimate of time, how long this will take. Stuff happens in Canada. Weather happens all the time in Canada, let alone just normal everyday stuff. So if you see that end date coming and it looks like you're going to go back to that exempt entity, that city, that county, that church, whoever you're working for, and say, hey, I need you to get another project exemption certificate because that due date's coming up. And all they got to do is go on. And a lot of times they'll just call Adina and say, hey, we need more time, and say how much time you need, 90 days, 100 days, 180 days, what do you need? No problem. It's out there, print it off. It's just that easy. And so they'll print it off, and now they'll give you another copy of it. So here's the thing. When you get a project exemption certificate, you're going to keep a copy in your records, of course, but you're going to make some copies of this. One, a lot of times they'll make one out to you, which is, it's nice to have that. They don't have to. A lot of times they'll just give you this. I would ask them for a copy of your exempt entity certificate. And I'm saying this, and it's not, I meant this project exemption certificate. Sorry about that. So I would ask them for a copy of their exempt entity certificate, the one I was just on, but also they'll give you a copy of the project exemption certificate. You're going to make copies of that, one at least for your records. Then you'll use one that's not, they're not filled out. It'll have the job on there, and you will take that to your supplier to buy your materials without tax. Now you'll make a bunch of copies because if you hire a subcontractor, you'll give your subcontractor two. At least two. You'll give the subcontractor one. Well, you'll make it out because they're now the vendor, the purchaser, or I'm sorry, the vendor, the seller, and you are the contractor, the purchaser. So they're trying to capture all the different folks. It gets confusing because you'll see vendor, and you're like, well, I'm not a vendor, I'm a contractor. Think of the word vendor as the seller, and then purchaser, contractor, subcontractor, that's all. Just think of it as seller and purchaser, seller and buyer. So the buyer is the one down below. So as a contractor, you're buying services from that subcontractor. As a contractor, you're buying services from the subcontractor. So you'll have one, and you'll make it out to them with that information. You'll want one for yourself, and they'll want one for their records. And then you'll give them one that's not filled out, and tell them to go make copies of it because that's what they use to go buy their materials without sales tax. Also, if you get any of these certificates and they have the word sample on it, they are no good. We've had people do that before, just FYI. Now, there's another kind of project exemption certificate. I just told you about exempt entities. How you can recognize that it's an exempt entity is it's a nonprofit organization. Can kind of recognize that. Well, you could get a project exemption certificate from a for-profit business. They're called Enterprise Zone. They're HPIP, High Performance Incentive Program. Typically what this is the process for that project exemption certificate starts with the Department of Commerce. And so in order to qualify for that, they have to actually qualify for an income tax credit, the High Performance Incentive Program income tax credit. So typically they are building a new, usually it's like a manufacturing plant or something, but they're hiring a certain number of employees, this type of thing, paying them a certain amount. If they qualify for that, then they can apply to the Department of Revenue for a project exemption certificate for that particular job. Okay, so that's it. The project exemption certificate itself works the same as far as you take two copies, that type of thing, but it's different. The process is longer. So it also has a start date and an end date, and they can also get it extended based on delays that could have happened. So I just want you to be aware there's a couple different kinds of project exemption certificates. These are just about the only thing that will exempt your materials and your labor. Wonderful. Also, if you have to rent or lease a piece of equipment on this project exemption certificate job, you can use the project exemption certificate to rent or lease that equipment without sales tax. Cannot buy it, can't use it on any other job. You can only use it for that job, but for that job. So let's say I have a contract where I'm going to go out and change all the fixtures in a church, and they're on the ceiling and they're way up there. So I decide to rent a lift for this. And so I can take the project exemption certificate to the rental company and say, hey, this is for project. They would rent that to me without sales tax. Now I can't take that lift anywhere else and use it on any other job. I can't buy that lift, but I can rent it for this project exemption certificate job, and it would be exempt with no sales tax. There's a couple things that are taxable no matter what kind of job, even if you have a project exemption certificate. That would be things like a temporary storage container. Contractors use those all the time so they can store materials and tools and things like that. Those are taxable because you're the end user. Porta potties, they consider you the end user of those, pardon the pun. So those things like that will pay tax no matter what. Your tools and equipment typically. There's another kind of project exemption certificate. You may never run into it, but I just want you to be aware. It's an agricultural project exemption certificate. Now it's only been around like 3 years, 4 years. Now it's very, very specific. So if you look on the screen, if you see that, you'll hear us call it a NAICS code. It stands for the North American Industry Classification System. Every industry has their own number code. So it's so specific that they actually listed in statute that code number that are able to apply for this project exemption certificate. They also said, well, it's only good for building a building structure, and the job must be $50,000 or more. And only these, so the NAICS codes are for cattle feedlots, dairy cattle and milk production, hog and pig farmers, poultry and egg production, sheep and goat farming. The end. That's it. So if you have somebody say, well, I want to put, I don't know. I was going to say a fence, but I meant to tell you that agricultural fencing is now exempt. That's new since July 1st. I'm not sure if any of you work for farmers. In the past, that would have been taxable. Prior to July 1st, it was taxable. Contractor would pay tax on the fencing, collect tax on the labor to install it. It's not a building, it's not a facility. However, since July 1st, agricultural fencing surrounds agricultural property. It's exempt. So you can buy you would use, what you use for that is the agricultural exemption certificate. That's an ST-28F. So that's fairly new since July 1st. So FYI, I'm not sure any of you knew that one. Now you can tell your friends and they'll just maybe throw something at you. I don't know. But that's another project exemption certificate. I'm not sure if anybody does work on, oh, I want to show you about this first. You could get an exempt entity certificate like this, possibly. Now, there's very few places that have them, but they do exist in this world. We call them by or on behalf of exempt entities. There's not, like I said, there's not very many of them. Now, if you look at their exemption, it looks just like the other one. But what's different is the language on there. It says, contractors may use this certificate in lieu of a project exemption certificate, although it is recommended that an exempt entity obtain a PEC. And then it has a note to the retailer. It says, hey, retailer, materials purchased or furnished by a contractor or the materials and labor of a subcontractor on real property projects may be purchased without tax using this certificate. It is not necessarily for the entity to obtain a project exemption certificate. Yep, that's a real certificate. I've had contractors call me and say, is this real? Did somebody make this up? Nope, it is real. Definitely is real. But it's very limited. So places that would have it were like domestic violent shelters, let's see, humane shelters, rural volunteer fire departments, Easter seals, wayside waste. There's not too many. It's very limited. That's why you may never come across it. But I just wanted you to be aware that this creature does exist. Let's see. I don't have it up there, but I'm not sure if you work on manufacturing equipment. So example, in Topeka, we have the Mars plant. They make the M&Ms and things like that. So that's a manufacturing company. So let's say they hire you to go in and work on their manufacturing equipment. I don't know what, I actually don't know what they use in there, but I'm just going to say there's this assembly line built thing. If you go in there to fix it and you're working on that manufacturing equipment itself, well, you can buy your parts without tax and your labor is not taxable. So they can buy that equipment without tax, and then any repairs or maintenance to it is not taxed. Here's the thing though, any real property there is pretty much going to be taxable. So any part of the building, general air conditioning, general heating, their plumbing, their anything that's attached to the wall there. So let's say you got a cable that goes from the power box, and then it goes to the equipment. From the power box to the equipment is going to be part of the manufacturing. From the wall on is basically part of the commercial building. So pay tax on materials, collect tax on the labor on the commercial part. But that it's an ST201. It's called an Integrated Production Machinery and Equipment Exemption. And it's one you just print off the Department of Revenue website. And that's what you would use to buy parts without tax, and put one in your file to show why you didn't pay tax and why you didn't collect tax on the labor. There's one very similar, an ST203. It's a warehousing, and it almost acts exactly like the other one. It's for warehousing, so your distribution centers, also for grain elevators. And we're talking about the equipment that does that. So in a distribution center, we're talking about the storage equipment. So for them, that would be possibly their forklifts. In fact, that's part of their warehousing, their racking systems. But again, the structure itself, it's going to be taxable. But you would take one of these and get it filled out and put that in your records. Statute of limitations 3 years. Project exemption certificates you have to keep 5 years. So I always tell contractors, if it was me, I'd just remember 5 years, keep all of my stuff for 5 years. I think I'd do that anyway, which you can keep it electronically, scan it like a PDF or something. You can keep paper, just make sure that it's not that thermal paper where the ink disappears, and make sure you keep it away from the hand sanitizer because that'll make stuff disappear. So just a couple things that have happened. Let's see here. I'm not sure if anybody works on appliances like freestanding refrigerators, freestanding washer and dryers, freestanding stoves, freestanding microwaves, things like that. Those things are tangible personal property, not real property. So if you work on somebody's washer and dryer and you go there, they may think that, well, their labor should be exempt because this is residential. Well, this is tangible personal property. It's not real property. There is no designation for residential or original construction when it comes to tangible personal property. So you would just collect tax on your final bill to them. Another good reason to use all applicable sales tax included when you invoice, especially if you're working on appliances. So you would be able to, and with that, you would be able to buy the parts without tax using a resale exemption certificate and collect tax again on the final cost if you're fixing somebody's washer or dryer, that type of thing. Contractors are the end user of their tools and equipment. So when you go buy those, you pay tax on those. Now, on your federal income tax, you may have certain deductions and things, depending on if it's able to be depreciated, that type of thing. But that's federal income tax. Sales tax, when you buy that, you're the end user of the tools and equipment. So you would owe sales tax when you buy those things. So you want to keep your receipts for those, because when they audit, they'll check things like that. Or remember, compensating use tax, if you bought it outside of the state and didn't pay enough tax. Now, if you rent a piece of equipment, it's just like buying, because the statute talks about selling and renting or leasing. So just imagine, just think of leasing, that I'm just buying it for this amount of time. So same thing. It's the same tax, everything. So if you rent a piece of equipment, you're the end user of the equipment. The default on that is they need to collect tax from you on the total cost. You need to pay tax on that as the end user. However, I already told you, if you have one of those project exemption certificates, you can rent a piece of equipment for that job without sales tax with that project exemption certificate. So remember that a lot of contractors forget about that. Now, a lot of contractors kind of get confused sometimes because they feel like they're renting equipment, but the equipment comes with an operator. And what I try to tell people is, if you're renting equipment but it's coming with an operator, don't think of it as renting equipment anymore. Just think of it as hiring a subcontractor and apply the rules of subcontractors. So they would, and basically most of the time they're only doing the labor, the service. So if what they're doing, first of all, is what they're doing a taxable service. And then if it is the labor taxable? If the labor's not taxable, then the rental of their hiring them is not taxable. So, and a good example would be a commercial building. And let's say it's an existing commercial building and we're an HVAC company and we're putting a new unit on the ceiling of this building, and we hire a crane to come over and move it for us. Well, just moving one thing from here to there is not a taxable service. If that's all I do, if I'm not part of the installation. Now, if I get out and I'm part of the crew that installs it, now the whole thing becomes taxable as part of gross receipts, like that receptacle with the bakery. But if all I'm doing is moving this thing from here to here, that's not a taxable service, no matter where it's at. So just FYI, so take a look at that. So what I've told you today is I really browbeat you about the materials. You're going to pay tax on the material, sales tax or compensating use tax most of the time. You need an exemption certificate for a lot of the exemptions, but remember there's two that don't have it. That would be the residential and the original construction of a building or facility. But the ones that do have an exemption certificate, that would be a project exemption certificate, an exempt entity, integrated production machinery and equipment. In our book, on or about page 16, we have this decision matrix. And basically what this is basically if you answer no to all of these questions, then you will pay tax on the materials and collect tax on the labor. So what we're trying to do here is just jog your memory and make you think, hey, is there any way I can get any portion of this exempt? Well, we start off with the public water supplier because most people are not. That way it just goes right on to the next one. So are you working for a public water supplier? If you are, ask them for a PEC or a ST28EE. If no, well, now you go on to the next one. It says, well, is this a project exemption certificate? Do they have a project exemption certificate to give you? Remember, if that's the case, well, that'll exempt your materials and labor. It'll exempt your subcontractors' material and labor. If you answer no to that, well, then you'll say, well, look at that exempt entity certificate. Is it one of those by or on behalf of exempt entities? So look at the language on there. If it's no, well, now we're just going to say, well, is any part of it then exempt? If they just gave me the tax exempt entity, yeah, I have to pay tax on my materials, but at least that will exempt my labor if they're paying me directly for that, if I'm a contractor. If I answer no, well, I'm getting down there now. So now it's like, well, is it residential? Is it original construction? Remember 5 definitions? No. Well, the last one, it talks about that integrated production machinery and equipment, the manufacturing or the warehousing exemption, ST201, ST203. If I answer no to that, well, I pay tax on my materials, I'll collect tax on my labor, and I will invoice them, all applicable sales tax included, if possible. A question I get all the time about that is, well, you know, who I work for, they won't accept an invoice like that. And I tell them, well, then you don't invoice them like that. You got to work. So, you know, if you can get away with just all applicable sales tax included and it works for you, that's the best way. But If that means you don't work, then don't do it that way. Well, I shoved a whole lot of information in your head in a short amount of time. What I have up on the screen right now is my coworker, Roger, and my contact information. That's our direct line, direct email. Feel free to give us a call, give us an email or something if you have a question. This is kind of tough, this sales tax stuff.